People get sold on this idea of buying a home, they'll live in it for 5 years, they'll sell it and move on to the next one. That very rarely makes any financial sense for most people. And I'll explain it like this. If you have a $500,000 mortgage on this first starter home that you're buying, for the first 5 years of your mortgage, if you have a 7% rate, you make about $200,000 worth of mortgage payments in the first 5 years of your mortgage. $170,000 approximately of that is going to go just to interest, and $30,000 of that $200K that you spent is going to actually go towards building your equity in the home. Now the problem here.
Now that kind of sounds like a trap. Like from the current mortgage you have, you get about 30K on there, but you also have appreciation. That's where the actual building wealth is. So I get where he's talking.
Then you've only built 30K worth of equity and a small amount of appreciation. You go to sell that in 5 years and you're breaking even, right? You might as well have just rented the home. So the key is, instead of you selling at the 5-year mark and being a break even, you're going to hold on to that first home, maybe pull some cash out to help you buy the new one, but you need to hold on to this at least to get to the halfway point on your loan, right? Because
so
at that point,
I get what he's saying here. So the first couple of years, first 5 years, when you have a mortgage, a lot of it is interest front loaded. And that's because a bank knows that when most people stay in their house or refinance within 5 to 7 years of living there, some areas a little bit different, but that's like the national average from the Association of Realtors out there. So what their bank is betting on is that you stay there at least that much and they can make more money off of lending you that money. It's a business for them, obviously. So that's where they're making their money. Now, when you are making those payments, you're barely paying on any of the principal. But the caveat is if you make one extra payment a year, so the 12 payments, you make a 13th payment, that can shave off 7 years of that mortgage lifespan. You're putting more to principal, so you're starting to gain more equity in it. Now, the equity is really gained on the market increasing. So yeah, your mortgage in this instance only went down 30K, but the appreciation you had over the years, that's when it actually really built up.